Welcome to the Steve Olson Show, January 5th, 2026. It's the first Monday of the year. We've got five things we're going to talk about today. Everything Southern California real estate. Number one, the average sales price in Orange County and where we ended up. The numbers I think are going to shock you. San Diego, average sales price also went through some significant changes. We'll talk about that today. Three questions coming into the show. First one is the cost of home ownership, and does over 5 years, does it actually make sense to buy a home, or are you technically losing money? Number four, we want to buy a home, but when should we wait for rates to come down? And then fifth question or third question for the day, number five, we're thinking about selling our home this year. Is there a perfect time to list your home? So let's get into it. All right, let's talk Orange County for a second. If you were to go back a year and look at all the prediction posts from a lot of the experts on Zillow and Realtor, and all the other forecast things, a lot of people were going to say that the numbers in San Diego and Orange County were not going to look good in 2025 because of interest rates and all of that stuff. So, believe it or not, I actually have good news for you. Let's get into a screen share. Now, when I say that the numbers were going to look bad, everybody forecasted a slowdown. And so what we really want to know is people that own the homes in Southern California is where is average pricing? Where's the market trending? How does that look? So if we look at this chart, this is as of today, January 5th. 2026, the average sales price for a home in a trailing 12-month period in December 2025 in Orange County was $1,480,427. It actually went up 3.7%. Now, I don't have the exact numbers. I probably should have prepared them for today's show. I want to say that most people were forecasting 1% to 2% for Orange County, so it beat expectations, which is great. Last year, the average sales price went up 1.3% over the year before. I did not include the COVID months before that because those are kind of like, it's an anomaly. The market was crazy. We all know that. But the good news is the market outpaced what we were supposed to do by about 2 points. Now, in Orange County, there are more 5, 10, 15, 20, and $30 million homes selling right now over the rest of history, right? So those are definitely taking the average sales price of homes and they're putting up. There's a lot of infill that's going in Orange County, a lot of specs, a lot of higher end condos. This number that you're looking at, 1,480,427, this is condos, townhomes, single family. It is all residential real estate. If you guys want to know what the specific numbers, how they break down, I will put a link in the description that will break this down based on like single family, condos and townhome. We'll take land out of that. Commercial is obviously not a part of this. Duplexes, triplexes, fourplexes, those are all omitted. But we'll break that number down by single family condos, all that fun stuff. The reason why in this video that we blend all of that together is because we need a lot of data to tell a very accurate story. And the only story that we're looking to tell right now is, in general, is the market trending up based on average sales price, or is it trending down? And when you take everything and you average it around or average it all together, the average sales price of a home trailing 12 months as of December 2025 is up about $50,000. Now, it's not crazy. I think if a really healthy real estate market year over year anywhere in the country is going to be around 4%, 4.5, maybe 5. Believe it or not, Southern California, we've had years where it's been like 12%. Like, that's nuts. That's a little bit too high. So good news, if you live in Orange County, the average sales price of a home did go up 3.7% a year. What's going to happen this year? What is 2026 going to do? I think it's going to do better than 3.7%. I don't think we're going to hit 8% or anything like that, but a lot of the market has already kind of acclimated to new interest rates. Actually, later on in today's episode, we'll talk about what interest rates are right now and where I think they're going to go, which is really important. But I do think the average sales price of a home in Orange County is going to continue to increase. I do think we're going to see more record-breaking sales this year. And I think it's going to be business as usual. Most of Orange County is landlocked, meaning they can't really keep building inland. There are some spots you can do it. But for the stuff that's keeping that average sales price high, I think it's going to be more of the same. So if you want a number that you can come back to on January 5th, 2026, when I make this video on January, whatever, 2027, I think we're going to hit about 4.8%. Yes, I think we are going to outpace last year. We'll see if I'm right. Let's get into number two today, the average cost or the average sales price of a home in San Diego County. Now, believe it or not, while not as high, San Diego County significantly outpaced Orange County, it did really well, and there's a couple reasons for this. San Diego County has a much different inventory crisis, if you want to call it that, than Orange County does. There's much less inventory based on the population. So when there's less inventory with more population, demand tends to be a little higher. When demand is higher, pricing goes up. Now, while the average sales price of a home inside Orange County is much higher than San Diego County because we're a much more broad market, we did go up 6.9% year over year. Last year, we did 3.5%. I think the industry trends or the market makers or the people discussing the market at the beginning of the year, if I go back, I believe they were forecasting somewhere around 4.5% a year. So we outpaced that by a few points. And again, same thing as Orange County. There are a lot of record-breaking sales. You are seeing stuff in Rancho Santa Fe and La Jolla and Del Mar sell for pricing that we really haven't seen before. I think it's going to be more of the same this year. Are we going to hit 7% appreciation in 2027? Or 2026, when we make this video in 2027, will we see record appreciation? I don't know that it's going to be 7%. I would love to say it's going to be 7, 8, 9%. I mean, that would be amazing. I think the income is a little bit lower. I know the income is a little bit lower in San Diego than it is in Orange County. It's not trending ahead as much as it is in Orange County. So there is a ceiling of where that is going to kind of hit. My guess, if I had to put how much appreciation we were going to have in San Diego County in the next year, if you were going to hold me accountable to this, I bet we'd be somewhere around the 5% range. I still think we're going to go up percentage-wise more than Orange County will, just because our average sales price is significant. And listen, in San Diego, I happen to live in San Diego County. We live in Carlsbad, California. I still think across the entire coast, if you go all the way from Northern California all the way down to Imperial Beach before you hit Mexico, I still think San Diego County has the best value for coastal real estate in the entire state, arguably in the entire country when you factor in climate and all that stuff. And so when that happens, typically that means there's going to be a little bit more room for pricing to grow. I think it's going to continue to go up. I really can't tell you that there is a city in San Diego County that's on the coast that's going to go down this year. I think every city is going to go up. So if you're thinking about buying a home this year in San Diego County, especially on the coast, I think you're going to be safe no matter well, I shouldn't say no matter what price you buy at, but as long as you buy competitively and you get the right mortgage and you hold it for the right amount of time, which again, we're going to talk about later in this episode, I think you're going to do really well in San Diego. So my guess for San Diego 2026, we're going to say 5.5%. It's not 9, it's not 7. There is going to be a little bit of adjustment. I do think we're going to go up, but like I said, our ceiling of growth is a little bit shorter than Orange County just because of incomes. All right, our first question for 2026 in regards to real estate in Southern California comes from Sierra, from Alicia Viejo. And Sierra says, I was doing the math on buying a home and it doesn't look like we'll even make money in 5 years. Am I doing this wrong? Now, Sierra, when you submitted this question, by the way, if you want us to answer your question, just go to steveolsongroup.com/ask and you can submit your question there. We'll answer the question and then email you a copy of the video once we put it out there. Sierra did not give any backing math. Or like any formulas or any links that she used to come across with this. So Sierra, if you want to send that to me, I'm happy to make another video and justify what I'm going to tell you. But I did a little bit of research on Alicia Viejo, and we're going to do some math based on a purchase price of $1.7 million in 2026. And how long, if you pay $1.7 million, I'll give you some assumptions, interest rates, HOA, taxes, all of that stuff, how long it's actually going to take to break even on the home if you need to sell it. The numbers are going to shock you. I'm a math person. I know math probably better than most. And the numbers that I came up with is not what I was expecting. So let's get into that. And I'm going to give you some comparing and contrasting, actually. If you were to rent during the same time, paying market-based rent and taking the difference between the mortgage payment and your rent, and then just putting that into a Vanguard index fund, their S&P index fund, would you have ended up better 19 years from now doing that than owning a home? I think the results from that are going to shock you. So here are the assumptions that I wrote down. Number one, the average sales price in Alicia Viejo, we're going to use $1.7 million. So I'm going to assume that you're going to put down 20%. That's going to be $340,000, which means your loan amount is going to be $1.36 million. And I'm going to assume that your interest rate right now, we'll use a simple one, 6.25. Yes, you can get into the fives with certain things. You can do ARMs and all that stuff, but we're going to do a 6.25% rate with 30 years. Okay. So that means when you take your mortgage principal and interest, now I didn't include insurance. So insurance is different everywhere. So we're going to leave that out. That means you're paying about $106,600 per year. Okay. HOA, I'm going to assume you're going to pay probably around $3,500 a year. Property taxes are going to be around 17,000 because they're about 1%. And then we're going to forecast that annually you're going to have repairs somewhere in the $3,500 per year range. You got to factor all this stuff in because homeownership is expensive. That means annually you're paying $124,520 per year to own a $1.7 million home. That's a lot. Right. That means if you're paying 124,520, I think that's like 10,375 a month or something like that. That means you're probably making 30 grand, $360,000 combined salary if you're married, 30,000 to 36,000 a month if you are single. So let's talk about this. Your year one pay down, because of how 30-year structures, is only $15,500, which means your true annual cost of owning this home, like the amount of money coming out of your pocket that you are pouring into this with equity buy down and all of that stuff, interest, all that, is $109,000 per year. I would write that number down. I probably should have written this on the screen. Maybe we'll do that on the next video. I'm going to assume that on average, we're going to appreciate 4.5% annually over the next 19 years. We're going to go through a dip. That's going to happen. We're going to go through multiple dips in 19 years, right? So you're going to have some that are going to go way up, and then we're going to go down a little bit. Then we're going to go way up, and then we're probably going to go down. That cycle is probably going to happen twice in 2 years. But if you blend the average over the next 19 years, which is what we're going to talk about, 4.5%, I think, are fair. When you go to sell the home, closing costs are probably going to be 7.5%, give or take, 1 to 1.5% in closing costs, and then repairs. You got $4,000 in repairs, 5 to 6% in real estate commission. So we've got that number's factored in. Okay, so I ran this through 3 different calculators. I ran this through Excel. I did it myself. I ran it through ChatGPT. I ran it through Claude, and then I found one calculator online that I ran through. Believe it or not, the calculator that I found online spit out totally different numbers than when I ran it through Claude and ChatGPT and Excel, which all pretty much came up with the exact same number, plus or minus a tenth of a point. So to get to this, what we need to do is we need to take the sales proceeds, take out the remaining loan balance, take out the selling costs, take out your down payment because you already paid that in, and then take out all of your true cost expenses. Here's the number it came up with. You ready for this? About 19 years to break even. 19 years. Now, the biggest factor we're facing right now, you're like, 19 years of owning a home and I break even? And the answer is yes, and here's why. If we're only factoring 4.5% appreciation year over year, and your interest rate is 6.25%, your interest rate is losing money year over year, right? So we have to wait for the compounding effects of 4.5% of gains to outpace that interest. That's going to take a while for that to happen. But here's the number. In year 20, if we go up 4.5% a year, that means you're going to sell your home for $4.1 million. So it's going to go about up 2.3 times, which I think is a fair assumption. Net after selling costs is going to be about $3.8 million. Your remaining loan balance from that original 1.4 is going to be about $720,000. And that means at closing, your cash received is about $3.07 million. And so you're saying, like, wait a second, Steve, in 20 years, I'm going to sell my home for $4.1 million and I'm going to get a check for $3 million. I made $3 million, right? No, you didn't make $3 million. And here's why this is not talked about. The reason why this is not talked about is because this is a major number. And if the banks knew that we were talking about this, or like the banks are never going to talk about this because they just want to say, congratulations, you owned a home for 20 years. You made $3 million. Like, there was probably nothing else that you did to make $3 million. But the numbers don't stop there. In order for you to make $3 million in 20 years, you had to invest a down payment of $340,000, right? So that's money that's getting paid back out of that $3.07 million. And get this, you had to pay $109,000 a year times 20 years, which would be about $2.18 million in expenses you had to pay to own that home for 20 years, plus your $348,000, your $340,000 payment. So if you add the 2.18 million to 348,000, that's going to come up with about 2.52 million. Now, on year 18, that didn't happen, right? If you do, maybe I'll put a chart in the blog post. If you guys want to click the link in the description, I'll show you that. But when you get that cash of 3.07 million and you back out the 2.52 million, you've got about a half a million left over. The year before, that number is significantly smaller. And this is at about year 19. Now, I know what you're probably thinking, like, it's better than renting. And the answer is yes, it is better than renting because all of that money we spent for 19 years, we're basically getting all of that refunded on year 20 to us, right? So it's kind of like a forced savings account that we put in there. So if you bought a $1.7 million home, put 20% down, 6.25% interest rate, and 4.5% appreciation plus taxes, all that fun stuff. I did not include insurance, which is definitely going to be a hefty sum that's going to change these numbers a little bit. In about 20 years, you're going to get all of that money back, right? In the meantime, it's costing, you to do that. You got to pay the mortgage. There's some, tax savings that you can do. There's some, finagling you can do to make that number a little bit better. But there is one thing that is going to change, and that will be rates. Now, we'll talk about it later on today in another question that somebody asked. Rates are never going back down to 3%. It's just not going to happen. If you're on the fence right now thinking like, hey, rates are going to hit 4 something, and when they hit 4 something, I'll be back in the market. Two things that I would be wary of. Number one, that's never happened twice in the history of the United States economy, so I wouldn't bet on that. And number two, if rates somehow do drop to 4.5%, the price of a home is going to skyrocket right back up because people's purchasing power increases for that, right? So it's kind of like do I want rates to go up or do I want the average sales price to go up? You can't have it both ways. But what this doesn't talk about is that I'm assuming that you're going to keep the exact same mortgage for the next 30 years. I know that's not going to happen. Almost nobody keeps a mortgage for 30 years because rates fluctuate. So I am going to assume that over time, the rate may drop down to 5.25, 5.19. Maybe you may get a high 4 here and there for like a couple of weeks. That may happen. I don't want to be a Debbie Downer. I do believe that the economy will be resilient and rates will fluctuate. If you time that right, even just a 1.5 point difference significantly changes the numbers on this, significantly. So think of this as kind of like worst case scenario. Now, is this going to go from 20 years down to 5? No, it's not, right? And I have this argument with people all the time. I've owned this home for 3 years and I'm already up this much. I should just sell and cash out. Well, you could cash out and get reimbursed for everything that you paid so far, but chances are you lost money in the sale because of commission, closing costs, holding costs, repairs, all of that fun stuff. Now, to be clear, does this mean I'm suggesting you shouldn't own a home? Absolutely not. It's still an amazing investment, right? But money in versus money out in this specific situation, assuming taxes never go up, right? We know they're going to go up. I did not factor for increasing property taxes. Assuming that HOA doesn't go up, HOA is going to go up. Assuming home insurance doesn't go up, home insurance isn't in this at all. That's a big factor, especially for homes in Southern California. And I did not factor if you were going to refinance the mortgage, if it goes down, right? So there's a lot of things that you can manipulate those numbers with. Now, let me take you for just for fun. Let's say that and I know quite a lot of people that are like this. Let's say that hey, I only want to own other people's real estate that they pay my mortgage. Like I only want to own investor real estate. I know quite a lot of people, more than you would think, that rent their primary residence and then buy investment properties. And then they do it enough to where their primary is paid for. And then when they have enough cash flow for that to buy their own home, they use the cash flow for that to pay for the existing home. And figuratively, they're gaining equity with all their investment properties, and the cash flow from the investment properties is paying their mortgage. So net, it's a zero and it's an appreciating asset. It's an amazing way to own real estate. It does take a while to do that. It's not something that you can do, overnight. It's a big plan. But let's take that out of it. Let's take investment property. Let's not talk about any of that. And let's just say, Steve, well, in a market where rates are so high, rent is significantly cheaper than owning a home right now. Like in some cases where we live in Carlsbad, the number is almost half, right? So let's say in Aliso Viejo, if we go back to the $1.7 million home with 20% down, that mortgage payment is about $10,000. I think it was $375 a month, about without insurance and all of that. So maybe it's upwards of 11. I don't know, depending on what insurance costs up there. I think you could probably rent that same home for $6,000 a month in Aliso Viejo. I haven't done deep research, but that's probably what it's going to be, which is about almost half of what the mortgage is, right? We'll leave that aside. So let's say, Steve, what if I just rented a home and then the difference between my rental payment and the mortgage payment, I took all of that money, which in this case would be $4,375. And let's say I just put it in a Vanguard fund for 19 years. And historically, what I found is that the Vanguard S&P index fund, there's a whole bunch of Vanguard funds, gives about a 10% return a year over the last 19 years, which is amazing. It outpaced everything else. Was a really good investment. So here's the numbers I came with. Whether this is kind of crazy. If you paid rent for $6,000 a month, and then took the difference, $4,375, and put that all in a Vanguard index fund. At the end of that, you would have invested $997,500 into that Vanguard fund. This is 19 years of monthly investments of $4,378. That's 228 months, just so we're clear. $997,000 and $500. That's how much you would have invested. That $1 million investment would have been worth 2.95 million today. So you would have made about $2 million on that money. So at the end of the day, you would have paid somebody $6,000 in rent. We should do the math on that. $6,000 a month times 228 months, which means you would have paid $1,368,000 in rent. That sounds crazy to say. $1,368,000 in rent. Let's write this down. And then you would have paid $997,000 in that. So we're going to say plus 997,500. That means all out of pocket, you would have spent 2.365,500. But you would have had the financial instrument that gained about $2 million bucks. So you would have spent 2.365 million, and then you would walk away. Yeah, a little over $2 million. You would have walked away. So you would have had a financial instrument of $2 million in your pocket. Okay, so let's talk about like money in your pocket. So you spend $136,800 in rent. You spend $997,000 in investments. So that money is gone. You spent 2,365. So that money is gone. At year 19, you now have $2 million cash in your pocket. Okay. So we spent all of that money. We got all of that back. So really, in order to do that, we lost $1 million if you think about it that way, right? We lost about $400,000 doing that. Okay. We spent 2.365 and then somebody wrote us a check back for $2 million. That's what our index fund gained over all that period of time. Now, I don't know about you, but if I take $365,500, which is what we would have paid, and we divide that by 228, I technically paid $1,600 a month in rent for 19 years. Not a crazy number. In 19 years of owning a home, you got all of that money plus $500,000 back. So you didn't lose any money. So in 19 years, the argument of paying rent plus investing the difference between now and then, yes, you would have paid $236 and then had $2 million in your pocket. When you were done, if you would have owned your home, you would have done the exact same thing, but you would have had all of that money in your pocket reimbursed with you. So I know this money is weird. Maybe in the blog post, we'll put like a little Excel grid, like side by side, so you can see like cost, money left over, cost, money left over. My gut talking about this out loud would probably tell you that homeownership was still better. Now, there are a couple like things that, like, remember how there were asterisks around buying the home? There's asterisks around renting as well. I did not forecast rent going up in 20 years. It's 100% going to go up. I did not forecast that you're going to be in the same home every single year. So they're going to be moving costs. So that number is going to change. The instability of renting a home, meaning can somebody physically rent their home for you for 19 years straight? In most cases, no. They can't rent the home from you that long. So there's going to be a lot of change in that. There's going to be a lot of disruption. Some of it's going to be planned. Some of it's not. Some people love moving every couple of years. Some people, like if you're somebody who wants to be in the same place for 10 years, 100%, I would buy the home. I would not rent it, right? So there are, nothing ever works exactly how it's supposed to, right? It's important to understand that, especially in real estate. But I think when you look at the raw numbers, we'll put it in the blog post, I can almost assure you that even though your break-even point is 19 years financially, it's going to make more sense to buy the home. Our next question comes from Michael from Claremont down here in San Diego. We want to buy a home this year, but are curious as to how long we should wait for rates to come down. Rates are going to be the common conversation the entire year because it's all the media's talking about. Rates are going up, rates are going down. There's way too much focus on like the Fed rate and how many times is it going to drop? Is it going to stay the same? Is it going to go up? How does that affect credit cards and cars and mortgage rates? When most of the time those changes in that Fed rate They're already built in, meaning when that rate gets around, you're like, why didn't everything go down? They lowered the rate. Isn't that better? Like, shouldn't mortgage rates go down? Well, number one, the Fed rate doesn't directly impact the mortgage rate. So that's the first thing to understand. We'll make a video about that later. And number two, most of the time, the daily rate that this is based on is already forecasted into the Fed decision. So the results that are happening from that decision are probably already baked into the route. That's why you don't see any crazy things. But the question that I think it was Michael from Claremont, is there a best time to wait this year? Where are rates going to go? I have this conversation with people all the time, and they say, you know what, rates are too high. When they come back down, I'll get back in the market. And I want to show you an interesting graph. I'll put this in the blog post. I'll put the link below so you guys can take a look at this. You should look at this all the time. I think a lot of the part of the market, a lot of the people in the market rather, need to come to terms with the fact that rates in the 3% and the 2%, 2.875, 2.65, I've seen, before 3.175, all of these rates, these are once in a generation rates. Now, am I saying these are never going to come back in the history of mankind? Yeah, actually, I probably am. And I'm going to give you a chart here that shows you something. I'm a Gen Xer, right? And so my parents said, hey, in the early 1980s, we paid like 19% for a home, and that was normal. No, it wasn't normal, right? Just like what I'm probably going to say, my kids, hey, when I bought a home in 2021, our rate was 2.875%. That wasn't normal. That was a moment in time rate. So if you're waiting for rates to come down and you think you're going to be able to price the market or time the market perfectly, chances are that's not going to happen. But I do want to show you this really cool chart that I think will help bring light to that. And I do think the market is really like reacting to this right now. This is the average mortgage rate per year, according to Fred. Now, I'll put this link in the description. You guys can click on this and look at it again. If you remember when I was talking about our parents, 18.63 in October of 1981. I was born August of 1980, which the average rate was, oh, look at that. August, I'm not even able to find it. There it is. August 12.25% rate. So in less than a year, it like almost doubled. That's crazy. All these gray sections right here, these are all recessions. That's what these are, right? So what do you see happening with the exception of the recession in 1975? Normally what happens right after a recession, rates drop, right? And then they go up. And then what happened here? The recession ended, rates dropped, and then they go up. And then we hit a recession, then rates dropped, right? And then we got a little peak right here, a significant rate drop, then some, stuttering of markets, and then we hit another recession. This was the savings and loan recession, and then rates dropped, they adjusted, then they dropped, then they adjusted, and then this is the dot-com recession, the dot-com boom, or bust rather. And then what happened then? We went on another one, and then all of a sudden, somewhere around 2002 to 2004, Bill Clinton signed legislation that says that mortgage-backed securities basically could buy whatever they wanted to buy. And then that caused a huge run on housing. Huge run. One of the biggest runs we will probably ever see. And here's the interesting thing from 2005 all the way to the collapse is rates for the most part went up, right? When you give money away for free, rates can go up because people don't care. It's free money. So we had rates go up. And then you had 6.73, 6.79, 6.14. We were doing deals back then where the first mortgage was in the sixes. The second was 9 to 14%. And people were totally okay with it, right? That's just how the market was back then. And then you had the great housing crash recession. Now, keep in mind, of all of these recessions, 1, 2, 3, 4, 5, the 5 recessions before the great housing crash, real estate was the vehicle that pulled the recession out of the recession, that pulled the economy out of the recession. This was the only time where it was a real estate-based recession. And then what happened is you had arguably one of the longest bull runs we've ever had until this micro recession right here. And I say micro because nobody even knew it happened, right? It happened that quick, right? So even though there is technically a recession right here, and yes, the rates did drop right here, that recession was what? Look at the dates. February 2020, March 2020. What happened in March of 2020? Yeah, the pandemic, right? So the pandemic hits, the entire market freezes. We go into a micro recession. And what does the government do? The government says, hey, wait a second. We don't want the economy to go to crap. So what we're going to do is we're going to artificially keep rates really low because we want as much cash going into the market as possible. And for a little bit, it worked. But when you see these rates drop into the 2.8, look at that, 2.66 On Christmas Eve 2020, if you got a rate then, it was 2.66%. No market makes money at 2.66%. It doesn't happen. The issue that we ran into, there's two issues. Number one, the economy kept the rates low for way too long. And then because rates were way too long, people were like, well, wait a second, at 2.6%, like, I don't have to buy a $600,000 mortgage. I can buy a $1.4 million home. So that took the average sales price of a home and it ran it through the roof, right? When everybody talks about, oh, the COVID run up because people could live wherever they want. And yes, that's part of it. But the big part of the COVID run up wasn't because people could live wherever they wanted. It's because money was so cheap that you could exchange hands as many times as you want. And there was no incentive not to do so. So for a couple of years there, real estate was just going. I mean, you guys remember, home hits the market, 50 offers on the home. The highest winning home is 16% over what it was listed for. This was normal in that time. And so sellers right now are saying things like, oh, well, when we get back to a market that's normal, where we get multiple offers, I'll list our home for sale. And again, that wasn't a normal market. Buyers are kind of the same way. People have amnesia in real estate, right? When we go back to the way things used to be, we'll buy a home. But if you look at this chart, there was never a time, and yes, this data only goes back to 1971. There are other things. I think the oldest data goes back to 1916 or something, and the rates are pretty much the average rate, like forever, is like 6.8%. That's like the average mortgage rate since like the early 1900s. But when you go pre 1971, the numbers are going to be kind of all over the place. I don't think there's a time in history where they were ever 18%. Just like there's never going to be a time in history where it's going to get back to 2.66%. Right? What I think you're going to see if you chop this part off, right? Like if we literally took this whole part and we chopped it off. Oh, I didn't realize I could even zoom in there. Let's see if we can zoom back out. We'll go edit graph, download. Oh, that's kind of cool. But unfortunately, I cannot get back out of it. Let's go back out of it. There we go. So if we chop this section off, and I know that's going to zoom back in, and then we chop this section off, right? We just cut those two out of it. I think what you're going to see is historically, the United States mortgage market has actually done pretty well because this number is probably going to flutter right here. And then we have all the numbers going down. And then, we obviously can't control this. This was a wild bull run. And then we cut this off. This graph doesn't look that aggressive, like a 6% interest rate looks like a really healthy interest rate. But because we're tainted, and what I mean by that is because this is still recent enough to where we remember this, and this is very recent enough to where we remember that, we have these wild floor and ceilings of what we think mortgage rates can do. And at the end of the day, these are not floors and ceilings because in our lifetime, I'm 45, we're never going to see 18%. And in my lifetime, also being 45 still, we're never going to see 2.66. I think you need to be really comfortable in that 5 to 6% range, a little up, a little plus. There might be some random markets that we need a 4% rate in, but to expect that anything could happen to get us back down to the low threes or high twos, I think it's irresponsible. And I think it's going to cause you to sit on the sidelines way too long. Is there a time this year when rates drop and it may make sense to do it? Rates are going to fluctuate like literally month over month. You could try to time it around a Fed announcement. If you really believe that the Fed was going to cut rates 3 or 4 times this year, I'm not convinced they're going to. My guess would be they hold strong on all 4. I don't think they're going to go up or they're going to go down. I could be totally wrong on this. Here's what I would focus on. Rather than worrying about the rate for the home, I would worry about buying smart. What I mean is, like, there's a reason why homes break record. And actually, in the next question that somebody asked that we'll cover after this, I talk about this a little bit. If you buy right, the rate's not going to matter, right? If you buy bad, meaning you buy bad location, bad condition, bad facing home, like an older home that's maybe at the tip of its economic obsolescence, like it's going to be hard to make money on that in the next 20 years. But if you buy smart, the interest rate, while it's still going to be a significant factor, I don't think is going to be that bad of a factor or that significant of a factor going forward. So my suggestion to you, if you were thinking about buying a home in the next 12 months, give or take, I think you're going to be okay. I really do. I don't think that buying a home in I would buy one when there's probably less competition, which would probably be right now. Spring's definitely going to be really competitive. I don't think we're going back to multiple offers by any means, but it's going to be more competitive. End of summer is going to be a really good time. Winter of next year, I promise you, is going to be a really good time. Is the average price of a home in winter of 2026, like the end of the year, going to be more expensive than it is right now? The answer is yes. So my gut were to tell you that if it didn't matter, I would probably be looking for my next home right now to about mid-March. I think that's probably going to be the best time this year to buy a home. There's going to be a lot less competition at the end of the year. However, by the time we get to that, I think pricing is going to be a little higher. It's just going to be a little bit more expensive, right? So I'd base it more on the location, the quality. Find a home that you feel really comfortable. It's almost impossible for real estate to go down if you own a home for 7 years. Doesn't mean you made money, right? As the earlier in today's episode we talked about, doesn't mean you made money on the home, but the value of the home did not go down. The reason why that's important is that when the values go up and you buy desirable real estate in desirable areas, it makes it easier in the future to refi. That is the number one reason to always buy smart. Okay, hope that was valuable. For our last question of the day, this comes from Mickey from San Diego. Mickey, hope you're doing well. Mickey asked, we want to sell your home this year, but is there a better time to list than others? Meaning, does it make sense to list now, during the spring, the summer, fall, or winter? And the answer is, I know you're going to hate me on this. It's going to be, it depends, right? It's not always as easy. Southern California is very seasonal. We do have a seasonal market, but not seasonal as it pertains to weather, seasonal as it pertains to like financial climates. And a lot of the newer developments, it's very heavily driven by the school year, meaning like especially here where we live in Carlsbad, the market kind of goes through this really quick push at the end of the spring semester because people want to get all of that done before the next spring. Schools here matter, and Orange County schools, well, actually, Orange County and San Diego schools really matter all over the place. So it's very seasonal like that. That's really important to understand. And they can even ebb and flow based on neighborhood, right? Some of the very specific like master plan communities have their own seasons of when people move in and move out. And this is important to understand because real estate, especially in Southern California, it's very local, right? It can be local down to the city, down to the zip code, and like I said earlier, down to the neighborhood. Uh, if you want a general time, like when you want to list your home, I'll just give it to you right now. It's spring, right? Early part of spring. But there's some things that I'm going to add into this that are going to sweeten the pot a little bit. I want to make sure I'm really clear. But if you're like, hey, I don't care about all the details. I don't care about my neighborhood or the zip code or the city or, macro or micro economics. I just want to know, like, when do I need to be thinking about selling my home? My answer would 100% be spring of 2026. That's when I would do it. However, here's how things can get a little interesting. Homes can only break a record. If you're taking notes, or maybe you want to highlight this or clip this, or I'll put this in the descriptions, homes will only break a record when all of these factors are met. Number one, they need to be in turnkey, modern, remodeled condition. Turnkey, modern. I don't mean modern in regards to architectural style. I mean modern like they're with now style. And it needs to be completely remodeled, meaning the day they close escrow on the home, they can move in. If they're in that good condition, that's a plus. If they're in an A+ location, now A+ location means a couple things. It could be where it is in the neighborhood. It could be the view that it has. It could be its proximity to the ocean. It could be its proximity to how walkable the neighborhood is. Is it right by the front gate? Is it away from the gate? Does it border the pool? Does it border a pickleball court or the common area? Is it in a cul-de-sac? Does it have a big backyard? Is it a corner lot? There's all these factors in real estate that if you're in an A+ most desirable location in the neighborhood, in the market with a view, it's probably going to break a record. Number three, if you have a competitive pricing strategy, meaning if you have an amazing home in an amazing location, but a bad pricing strategy, you're not going to break a record because you're going to cause a lot of like anxiety for buyers to give you that price because it's like, well, it's a great home. It's in an amazing location, but they're asking way too much money. And the opposite is true too. You price it too low. They're like, hey, it's a great home. It's in a great location, but it's priced low. Is there something wrong? So like having a real estate agent that understands pricing and understands how to use pricing as a marketing tactic is super, super important. Fourth thing I wrote down, and it's if it's the only option of like kind in the neighborhood. This is probably if all the others are true, but there's like 10 homes for sale in a neighborhood, that are like comps, it's going to be hard to break a record. And I know in today's market that really doesn't happen. But listen to this: a lower quality comp, like meaning you may have a 4,000 square foot home in, I think you were in Claremont, if I remember right, or San Diego. Um, if you have a 4,000 square foot home and in the neighborhood, and yours is like amazing, right? And then the neighborhood, another 4,000 square foot home that hasn't been remodeled yet, if that hits the market, you may think, well, that one is a not nearly as nice as mine. So that's really good because they're going to see that and then they're going to see mine. And that's going to be great. I'm going to get more money. And that's kind of true. However, the objection that's going to happen in that is the seller or the potential home buyer is going to look at the home that's probably priced cheaper and in worse condition than yours and say, hey, we've got this home for $2 million bucks. It's maybe not in the best condition, maybe not in the best location. Does the location matter to me? And then you got this other home. It's also 4,000 square feet. It's in amazing condition. It's in an amazing location, but they're asking $3 million. There's $1 million swing between the two homes. Now, between the two homeowners, they understand it because this one wasn't remodeled, wasn't as good a location. This one is crazy remodeled in an amazing location. So clearly, we can justify the $1 million price difference. However, from a buyer's perspective, the first question they're going to ask is, if I buy the cheaper home, is it going to cost me $1 million to get that home? Meaning, if I put $1 million into this home, can I end up with this home over here? And, maybe from a condition like remodeling the kitchen, the floors, the drywall, moving walls, adding a pool, all that fun stuff, they're probably going to be able to get there. However, they're not going to be able to get to the location, meaning maybe the $3 million one has an ocean view. This one doesn't. Maybe it's, north and south facing, not east and west. And, so it's got a better backyard, viewing. All these little tiny things matter. Right. So as you're pricing your home, you got to look at the competition in the market and say, is the cost that I'm asking for a no-brainer justification based on what else is on the market? If the answer is yes, it's probably going to do well. The last thing I wrote down, number 5, is exposure. Exposure meaning it's not good enough to list in the MLS anymore. All homes go in the MLS. All homes go on Zillow. All homes go on Realtor. That's standard. You get that with every real estate agent. But is there a process for outreach over potential buyers? Maybe they're within the brokerage of the real estate agent, or leads that they have generated on other listings, or like properties that have come off the market, or other people that they know, or other influencers in the market. Is there a social outreach campaign, right? Like a social media campaign that exposes this to the market? And is there a print strategy to put this in front of people? Now, I know what you may be thinking, like, hey, hold on, Steve, like, everything's on Zillow. If like my buyer's looking for a home, aren't they going to find it? And the answer is yes, but here's what you wouldn't know. In Southern California, there's no way to actually give you a factual, like, indisputable percentage on this. But if I had to guess based on all of our experience and all the conversations we have every day, 40% of all sales in California don't happen to plan. Meaning it's not, so nobody says like, or I should say the majority of people say, I'm going to buy a home in April, and the odds of them actually buying their home in April are like really low. Real estate never happens by plan, ever. What normally happens is they're on Zillow, or they're driving, they see an open house, or they see a post on social or a video on YouTube, and they see this house and they're like, whoa, that's a nice house. I had no idea that was for sale. Oh, the price is amazing. We weren't really thinking about buying right now, but like, this was the right price, the right location, the right condition. And then they go through the notion of like, well, can I sell my home right now? And can I sell it for enough money? And if I do, can I buy that one? And then all of a sudden, you guys hear it all the time. We were never thinking of moving, ever thinking of moving, but the right home at the right price came up. And so the marketing plan that we do, we have to be able to attract those people into this home, because without attracting people into this home, you're leaving a lot of money on the table. So real quick, turnkey, modern condition, A+ location, competitive pricing strategy. Ideally, you're listing when there are no other comps in the neighborhood. Now, I would probably put that number 1. If you were the only one for sale and you have a desirable neighborhood, home's probably going to do really well. If you're not in the neighborhood, you should be easily justifiable as to the price you're charging. And the 5th thing that I wrote down is, what is the exposure you and your agent are committed to outside of the MLS? You do all 5 of those things and you will break a record. Now, what do we need to do with the home to make sure that we can still break the record? Well, if you can't afford to remodel the entire home, meaning like a new kit, like I wouldn't remodel an entire kitchen just to sell it. Like you're just remodeling it for somebody else, and the ROI is going to be there. You may get a 1-to-1 return on that ROI. In some markets, you want to do it because it could be the difference of the home selling versus it not selling at all. And us, if you use us or your real estate agent, should be able to advise you on that. But here are 2 things that I would invest on. Number 1, I would invest on staging every single time. What we want to do is we want to position the home to help people understand how they would live in the home, not how you do live in the home, right? There's a reason why new model, new builds, like new build neighborhoods, like they go to the nines when they design these homes. It is because it makes you feel like envision of what life could look like if you were to over invest in the home. And they do it because it works, right? So I would invest in staging and I would invest in curb appeal. It should be the nicest front lawn in the entire neighborhood. There are plenty of studies that show that people have already made the decision to buy their home before they even walk in your front door, right? So curb appeal is important. The lawn needs to be cut all the time. There should be no weeds. Everything should be cut back. It should look like a show home if HGTV was driving by and only doing a show based on the front of the home. Painting, does that mean we should paint? 100%. The trim should be painted. You should get all of the sand staying on the bottom of the home. You should, definitely paint the eaves, everything. This needs to be like, I should feel excited if I'm a buyer and I'm walking up to a home. I should be looking at it and I should be having the thoughts of like, if I own this home, like, am I going to be proud for people to see my home? And if the answer is yes, you've already done half the work right there. Second thing that I would do if I wanted to kind of manipulate the market to break a record or to do really well, if I couldn't sell in spring, I would list immediately after a strong home, a strong comp sold. So if a record-breaking sale is in your market, even if it took 90 days to sell, once that thing closes at a really good price, I would list my home immediately after it, right? Because your home, if it doesn't match that record-breaking sale, is going to seem like an amazing deal if it gets listed right away. So all the people that followed that home that are like, oh, I wish I could have got it, but it sold for a big price, and there were multiple offers. Statistically speaking, the home that lists next will sell first, right? Third thing I wrote down under this, even though I talked about it earlier, list when you are the only option. So if there are no homes for sale in your market, chances are that's the time to list your home for sale, because if you have a desirable market, it's going to work. And then once you do all that stuff, assuming you have staging and curb appeal up correctly, if you list right after a strong comp, if you list when you're the only option, and the last thing I wrote down, number 4, if you saturate social with it, your home is probably going to sell in record time. Most homes, listen to this, that don't sell in record time, it's not because it is because they're incorrectly priced. It's because they're just in the pile, right? Let's say that all these notes that I wrote for today's episode were all the homes that I wanted to, consider. And this was, I think in San Diego, there's like 7,100 homes for sale or something like that. So think of like a stack of 7,100 homes sitting on somebody's desk. Like, you don't want your home in that pile. You want your home on the short stack. So the way that we do that is by marketing. It's by pricing. It's by making sure that, it's staged. The curb appeals. You want that home to stick out like a sore thumb. And the easiest way we can do that is to take that home, position it like an asset, and then manually put it in front of the entire market so that the people that weren't actively looking on the MLS see it, because at the end of the day, it's them that are going to drive the price of your home up. People will pay more for real estate if they are emotionally connected to it. People will pay more for real estate if they are emotionally connected to it. We get people emotionally connected with real estate by the design of the home, the staging of the home, the curb appeal of the home, the pricing of the home, the marketing of the home, the competition of the home, the location of the home, the view of the home. All these things can create an emotional connection with a buyer if you do it right. If you do it wrong and you rush it to the market and you don't pay attention, will it still sell? Maybe. 34% of all the inventory in San Diego County last year didn't sell. 34%. So that means only 2 to 3 are actually selling, whereas in previous years, all of the inventory was selling, right? A little bit different of a market right now. So how you position it and when you position the home matters. So the reason why I'm saying this, and I already forgot, okay, Mickey. So let me sum this up for you really quick. Spring is the best time to sell. But if you can't sell in spring, I just gave you the entire action plan to break a record anyway. Now, you may be thinking like, well, hold on, Steve. Like, I really don't care about breaking a record. I just want to make sure we sell. You can sell anytime in the entire year. Just follow that action plan. And we can do this with the smallest home in the neighborhood, the biggest home in the neighborhood. We can do it with almost any home. There are some like exclusions to where it's really hard to do it. But at the end of the day, if you really look at this as an asset you're trying to sell for a profit, if you just took a couple weeks before you rushed it on the market, and most times during the year in San Diego and in Orange County, we can still break a record. By and large, spring is the best time. That's also the most amount of competition, right? So if you're not the best home in the neighborhood, maybe you don't want to sell when there's a ton of competition. So in that case, spring may not be the right time to do it. However, if you take the time, you put in the work, and you do the right things, I think we can break a record in almost any market. in 2026. I think it's going to be a really good year in real estate. All right. That was January 5th, 2026. I hope this was valuable. We'll cut all these up. For those of you that want to watch story by story, we'll do this. If you have any questions, go to steveolsongroup.com/ask. I will put that link in the description. You can ask your question there. I'll answer them live on these videos. And I will see you tomorrow, same time, same stories. And maybe we'll look on inventory levels tomorrow of how San Diego and Orange County did. All right. Have an amazing Monday. We'll see you tomorrow.